Good evening, Singapore, ladies and gentlemen. Welcome to Millennium Week. Tonight, we are not talking about stocks. We are talking about what are we actually up against. Most people enter the market from the wrong angle. They ask, what stock should I buy? Where is the next breakout? What is moving tonight? But before strategy, we need to understand the environment. Every click enters a market with different players, resources, information access, and execution power. Before we talk about institutions, let's look at ourselves. If you trade or watch US stocks at night after work, just type US stocks in the comments. For those who typed it, you know this feeling. By 9:30 p.m., you have already gone through work, stress, messages, meetings, and decisions. Then the market opens, candles move, headlines come in. Suddenly, your tired mind feels it must be decided immediately. That is where the retail disadvantage begins. Not because retail investors are not smart, but because tired judgment can become emotional decision making. This exhaustion leads directly into the retail traps. Today we're going to discuss of three traps. Trap 1. Headlines create urgency. A headline appears, a stock moves, and we feel we must react. But the headline is not a trading plan. If we react only because news feels urgent, the market is controlling our timing. Trap 2. Tips create false confidence. Someone says a stock has potential, and we borrow their confidence. But if we do not understand the risk, timing, and exit plan, we are not trading with conviction. We're just following blindly. Trap 3. Trading alone makes bias louder. When there is no one to challenge our thinking, we keep searching for reasons to agree with ourselves. What we call conviction can become bias in a louder voice. Then comes the most dangerous habit, hope. A trade goes against us, and we start negotiating with ourselves. Maybe it will come back. We hold losers too long and sell winners too early. Let the plan decide, not your emotion. The plan exists to stop us from lying to ourselves when the market becomes uncomfortable. This brings us to the information circle. Sitting alone with charge is not enough. Excess precedes analysis. We cannot analyze an opportunity we never get it to see. Many retail investors think the answer is to study harder, more indicators, more videos, more headlines. But the real issue is not only effort. The real issue is input quality. If input is late, noisy, and emotional, then the analysis can also become late, noisy, and emotional. This does not mean we blindly follow people. This is another mistake. It means the quality of our information environment matters. If our only input is social media excitement, public headlines, and late night group chat messages, our analysis is already limited before it begins. Two investors can be equally smart, but if one sees only public noise while other hears structured views, their decisions will not be the same. The difference is not IQ. The difference is environment. By the time everyone is talking about the same stock, the early move may already be gone. Retail noise often arrives late because excitement spreads after price has already moved. A stock goes up first, then screenshot appears. Then group chats become loud. Then everyone repeats the same ticker. By the time this story feels obvious, the market may already have rewarded the people who positioned it earlier. That is why popularity is not the same as an opportunity. A stock can be popular and still be late. A move can look strong and still be dangerous. A headline can feel important and still be fully priced in. The stronger investor asks, where did this information start? Who moved first? What has already been priced in? I am still early, or I am becoming liquidity for someone who entered before me. FOMO feels emotional, but the cost is mathematical. Chasing affects your field price, stop distance, risk, and ability to stay calm. Let's say you see a stock breaking out. You are tired, the headline looks strong, and the chat is moving fast. You click buy at $100. But because of spread, slippage, and thin liquidity, your actual field becomes $102. Now imagine another participant, bought earlier at $97 before the crowd rushed in. Same stock, same chart, and same ticker. But the result is different because the entry structure is different. When the stock reaches $105, you feel happy. But the participant who entered at $97 has a wider cushion, better risk reward, and less stress. This is the retail tax. The market does not send an invoice, but the cost is real. That is why patience is not weakness. Patience is a position. Many people misunderstand patience. They think patience means holding a losing position and hoping it comes back. That is not patience. That is emotional attachment. The real patience means waiting for a setup where reward clearly outweighs risk. Sometimes the strongest action is no action. Sometimes the best trade is the one you do not take. Sometimes protecting your mental bandwidth is more important than forcing another entry. Think like a sniper. Sniper does not shoot because something is moving. A sniper waits for the right targets, right angle, and the right moment. In the market, that means better access, better context, and better risk rewards, and also better execution. The goal is not to be active. The goal is to be effective. The public information is available to everyone. If everyone can see the same headline and react at the same time, the question becomes, who understands the context better? And who can execute better? Access beats information because access gives context. Context tells us whether a headline is early or late. Context tells us whether a move is supported by real capital or only market excitement. Context helps us separate signals from noise. Professional networks matter because they challenge our assumption. They help us see blind spots. They allow us to compare one view against another before we risk capital. For real investors, the upgrade is not simply receiving more messages. The upgrade is better quality input processed through a disciplined framework. The keynote speech you see on YouTube is only a public half. The real context often happens after the official presentation ends. It happens at the round table. It happens in smaller discussions. It happens when the experienced investors compare what they are seeing, what they are avoiding, and what they are preparing for. When you're outside the room, you see the final headline. When you are closer to room, you hear the questions behind the headline. That difference changes how you prepare. It does not guarantee profit. Nothing in the market guarantees profit, but it can improve the quality of decision making. And in the markets, preparation is everything. Real access is not just about more information. It is about sitting in the right room with right people at the right level of thinking. The wrong room makes you emotional. Everyone is chasing, everyone is shouting tickers. Everyone wants fast answers. In that environment, even a disciplined person can become reactive. The right room slows the mind down. It forces better questions. It brings together people who understand the market is not only about one stock or one candle or one headline. Your circle can raise your standards, or it can pull you back into old habits. If your circle only talks about daily price swings or are trapped inside short-term noise, inside the right room, your thinking becomes sharper. From New York to Seoul, institutional finance moves on stages most retail investors never reach. These are not places where people casually chat the stock names. These are places where capital, policy, technology, liquidity, and market structure are discussed seriously. Being close to these rooms helps you hear the shift before it becomes a headline. This is preparation. If you hear the serious conversation earlier, you have more time to study, evaluate, and wait for confirmation. Most retail investors beat the story at the final stage. The article is published, the chart has moved, the group chat gets excited. Institutional thinking tries to meet the story earlier. Conferences and closed forums are where relationship and information really move, long before the retail crowd catches on. But understand this properly. The point is not to worship access. The point is to understand why access changes decision quality. When serious investors sit together, they are not only asking what is going up tonight. They are compare frameworks. They question assumptions. They discuss risks. They share what they are seeing across different markets and sectors. This kind of environment upgrades thinking. When we sit alone too long, our own bias becomes the loudest voice. In the right circle, our ideas get tested before the market tests them. Inside the flow, not outside it. Now let's move to execution. Before the US market opens at 9:30 p.m. Singapore time, liquidity is often thinner and bid-ask spread can be wider. Many retail traders pay hidden costs without realizing it. The price you see on screen is not always the price you get. Between the quotes and actual fill, there can be spread, slippage, and weaker execution. Institutions care about structure. They do not ask whether a stock is good. They ask how to enter, when to enter, how much liquidity is available, and what costs they are paying. For retail traders, this is a major mindset shift. Stop thinking only about direction, but start thinking about entry quality. Every click has a cost. Weak execution is a hidden cost. Larry Harris' book, Trading and Exchanges, remind us that the market is not just a chart, but this is a structure. There are buyers, sellers, spreads, liquidity providers, order flow, execution venues, and participants with different objectives. Retail order flow often provides liquidity to larger players. That sentence is powerful. When we rush emotionally, we may be helping someone else exit, reduce risk, or complete a larger plan. Let me give you an example. Think of buying a Rolex. The retail trader walks into the boutique, pays the full retail price, and waits for 6 months. The institutional insider walks through the back door, gets a better price, and walks out immediately. The watch is same. The difference is access. Same assets, different access, different cost, and different result. The real edge is not a secret indicator. The edge is access, preparation, execution, and a risk control. Tonight, I'm here to tear down the illusions. I'm here to show you the metrics. But showing you the problem is only the half of the battle. The other half is giving you the weapon to fix it. Later tonight, Coach Jason will share a deep dive on the power of networks and institutional patience in our WhatsApp group. Stay tuned. They will show you how to stop paying the retail tax and move closer to the structure that challenges you how to execute. This Saturday, we are hosting a private gathering for our veteran members. This is not a public seminar. This is a closed door roundtable. Seats are strictly limited to protect the quality of network. The guest list is being finalized tonight. If you're serious about upgrading your environment, do not let another week has providing liquidity to institutions. And if you are serious about upgrading your environment, WhatsApp Jason right now to secure your seat. Make your choice. I will see you on the inside.